Okay, welcome everybody to today's webinar on non-arm's length expenses in a self-managed super fund. So look, again, fast-paced webinar. What I want to get through is a fair bit in the next hour. So buckle up. We'll try and get through as much as we possibly can. And really, ultimately, what I aim to do is to help guide you through as much, I guess, as we can in regards to the non-arm's length expenditure changes that came in. Now, of course, for people like myself, but many others in the industry, we've actually been talking about this for quite some time. If we factor in the reality that that the legislation takes effect from the 1st of July 2018, we certainly can trace ourselves all the way back to probably 2016 with regards to some commentary around limited recourse borrowing arrangements. But if you're really honest about that, then those conversations actually started back in 2010, 2012, around the whole interest rate element. And I've spoken about that before, so I'm not going to take too much time discussing it. But ultimately, where we started with regards to lower than commercial interest rates and the non-arm's length nature of those sorts of transactions to where we've ended up with a 2 times expense multiple factor and expenditure linked to specific fund investments, to me is, undesirable piece of legislation. However, the outcome, the final outcome with regards particularly to general expenses, is certainly a lot better than what it started out as. So I'm going to talk a little bit through that whole gnarly timeline, effectively, holistically through the presentation today. Touch on the general versus specific expenses, work through an example of calculating the tax when we have a general expense, focus heavily as we do on the individual versus trustee capacity side of things, and then the CGT fallout. So when we've got specific expenses, the impact that has from a CGT point of view, and a non-arm's length income. So a number of things that we will take away from this, and I will talk about through the session as well how the impact of other pieces of legislation with regards to, or more to the point, other decisions that we're waiting on from the tax office with regards to contribution rulings and other things, how they impact the position of non-arm's length income as well. So where we're at now is that we have finalised, and the finalisation happened in June 2024, after a number of sort of failed attempts at it. We've ended up getting our piece of legislation that is largely, it would take out the specific fund expenses, specific asset expenses, but the general expenditure legislation is specifically targeted towards self-managed supers and small APRA funds. So of course, self-managed super funds make up 99.9% of all those funds. So it is clearly an impact item on our industry. And it's also an item that when you talk to the powers that be, and by referencing, say, Pete Burgess at the SMSF Association, the association is still, in my eyes, working really hard to try and work through some of the key issues, particularly with the LCR 2021-2 and the non-arm's length expenditure stuff. Of course, we're in this little bit of a holding pattern again, because we've now got the law, and we're now, let's call it 15 months later since the law, that we don't have the final rulings yet. We've got the draft, which of course there would have been significant commentary on. And so it creates this sort of scenario of, okay, well, where are we actually at? So we're waiting on that update of LCR 2021/2, and we're also waiting on the finalisation of the update of tax ruling 2010-1, because both of those, whilst LCR 2021-2 is all about non-arm's length expenditure, TR 2010-1 has a couple of, I guess, interesting elements, largely around in-specie contributions, but also some other comments that were in the final draft that will potentially have some consequences for super funds if we don't get clarity when those final rulings are released. Speaking of which, and I will reference them both throughout the presentation today, but speaking of which, they are both targeted for release in September. Now, as you know, if you look at slide 1, we're in September. That date started out as when it was the finalisation date, because the consultation period finished in January, and the initial date was mid 2025. Then it was identified as June 2025. Then June 2025 was replaced with mid to late 2025, and recently that was updated to September. Now, I was at an event with Pete Burgess on Friday last week, and he was discussing the specifics of the ruling, and in his commentary about it, he is definitely expecting this final ruling to be released this month. So I guess in 2 weeks' time, we can have a look and work out whether there is much difference. But I've based the presentation on the expectation that the ruling is largely unchanged from what we've seen in draft format there. But where we are now is, as I said, that expenses relating to specific fund assets, the income is derived from that asset, including capital gains, is taxed as non-arm's length income. And then when we've got general fund expenses, then we've now landed at this position where the amount that will be taxed as gnarly will be the 2 times the level of the general expenditure breach, or total taxable income less assessable contributions, or any concessional contributions in there. Most instances that we sort of are identifying this, and examples that we've always been provided, is you're really looking at the 2 times level of the expenditure breach versus the total taxable income less the assessable contributions piece. So that's where we're sitting from a legislative piece. Now, when this all sort of started, what we got from the ATO was that original LCR, but with that original LCR, we got the PCG 2020/5, which was our compliance relief. Now, you look at this timeline here and you see a little bit of a gap, right? And that gap is the creation of the regulations as such. So the legislation passed on the 28th of June, or roughly thereabouts, 2024, and came in effect the following quarter. So it came into effect from the 1st of July. But of course, the actual effect date of gnarly rules is the 1st of July, 2018. PCG 2025 provided compliance relief. So it ultimately identified that the tax office would not put compliance resources towards identifying gnarly issues prior to the 30th of June 2023. So what this means is that we've got this 12-month gap where there's no effective compliance safeguard with regards to non-arm's length income. Now, we all appreciate that the ATO in many respects have completed the 23-24 audit cycle, but there's always, if we assume that 80% of self-managed super funds lodge on time, there's also that 20% of funds that haven't gone through their 23-24 lodgement period or process. And so if something is identified within those funds, then the fact that there's no compliance resources being allocated just means the ATO aren't going hunting. But if you present them with a gnarly issue, then they're going to address that and potentially impose a tax penalty on people. So it's just that kind of concept of saying, if you haven't acted because you've been waiting on rulings and things, recognize that you don't have any protection of the ATO now. And if they're looking at things, then they're really ultimately in a scenario where they can impose the non-arm's length income provisions on any self-managed superannuation fund. So what are we at now? Where are we at with regards particularly to the concept of general expenses? So if we reference and we take the framework of LCR 2021/2 and link that up with the requirements under the legislative elements of it, right, where there is effectively a nexus between the non-arm's length expenditure and all fund income, so it's not a specific expense, then the original piece that came out from the government was obviously that all of the income of the fund would be tainted as non-arm's length income. And that was clearly a very disproportionate outcome to say, okay, well, if somebody doesn't pay an accounting expense, or if somebody doesn't pay an audit fee or something to do with the admin or investments as such, which might be a few $1,000s in a few $100,000 fund, it's relatively disproportionate to say, well, the entire fund is going to be taxed at 45%. But that's exactly what they did in the original ruling based on the legislation. They then obviously through various roundtable consultation landed at this end game of the 2 times the expense factor. So we're now in that end game where 2 times that expense factor is generally what we're going to be paying gnarly on. Now, what we are comfortable with from a legislative point of view in regards to this is that if you've got expenditure of a recurrent nature, so you've got expenses that the fund is paying every year, if there is a non-arm's length expense breach in 1 year, so if there's 1 year where you underpay the amount, then you are going to be subject or potentially subject to gnarly in that year. However, if it is then rectified, then the gnarly goes away, right? So the year afterwards, you'd be treated as a normal fund from an income point of view. So what we're looking at then is, okay, well, we're identifying what sort of expenses might create these one-off income situation, and we're looking at our actuarial fees, our accounting fees, audit fees, legal fees, admin management, general investment advisor fees, certainly trustee fees from a general expenditure point of view. However, like when we then click on and move into the LCR 2021-2, what we've got to understand, and this is, I guess, for me, one of the I'm going to call it anomalies of the SMSF industry, but it's certainly more one of the practical processes of the SMSF industry is most fund administrators, most accountants charge a fee, right? And they charge that admin fee or that accounting fee for the preparation of financial statements and the lodgement of the tax returns via potentially via their tax agent license. And so that effectively gets incorporated as a general deduction under 8.1. However, there is then this other element, which is, for costs for the management of the tax affairs of the fund, which is more specifically the lodgement of the tax return, right? They are deductible under 25.5, not 8.1. And as such, the gnarly provisions don't actually apply to them. So if there's any sort of arm's length consideration or question in relation to the tax return lodgement element, then it's not going to trigger a gnarly piece. And to me, that almost summarizes the complexity that they've created for what is very little revenue gain in this space from an SMSF point of view. And also recognizing that for those of us that have been in the industry long enough, when this whole thing first started back in between 2010 and 2012, when they talked about interest rates and limited recourse borrowing arrangements, they were focusing exclusively on the SIS arm's length requirements, which said that the transaction can be no more favourable to the related party. But they effectively indicated at that point in time that transactions that are favourable to the superannuation fund, are not a problem, because ultimately they want people to be able to save for their retirement. So it's when the tax office chose to go from being a compliance regulator to a tax regulator and said, okay, well, hang on, there's potentially some tax that we're missing out on here, that they've turned the whole thing on its head. But it's still problematic because, we're not differentiating between preparation fees and lodgement fees in all circumstances. And clearly, some people will have admin elements, and then they will have lodgement elements. And I often use the example of my own fund in these situations. For my fund, I do the preparation of the financial statement. So I use the accounting software, punch everything in, make sure it all reconciles. That sits well within my skill set. Maybe, let's be honest, it's roughly around my skill set of knowledge on self-managed superannuation fund, but I'm not a tax agent, right? So I don't have the powers to lodge my return. I could lodge it manually, but I engage a tax agent to just do that, and then I pay him to lodge the return. That fee there that I pay him is deductible under 25.5 and is not subject to the gnarly provisions. The fact that I don't pay myself to do admin, right, will come into this whole concept on the other side of the screen, which is the trustee versus individual capacity. And of course, what we know is that under 17A of the SIS Act, I cannot be remunerated for any duties or services that I perform in relation to my fund as trustee, that is hardwired of what I can't do. And so when they say, okay, well, are there circumstances where potentially I could be paid for the work that I do? And then I start to bring myself into the world of non-arm's length expenditure. We have to work out under what capacity am I doing the work, right? Am I doing it as a trustee? Because if I'm doing it as a trustee, then under no set of circumstances will it ever be non-arm's length income. And I think and I'm going to go through a couple of examples that we've seen in private binding rulings, but if we look at anything to do with administration, anything to do with the investment side of the superannuation funds and lodgements, they're all things that we can undertake as trustees of a self-managed super fund without necessarily having any professional qualifications to do it, right? You can be a trustee, you can prepare your financial statements, you can utilize whichever software you choose in that regard. You can lodge manually your return, so you don't need to engage a tax agent in that reference, with things such as doing the investment position and providing yourself with guidance on investments and effectively what you sign up for. We can do it all. We can self do. That's not the right word. I appreciate that, but yeah, we can actually go down that path. But then there's certain other things that we can't do without being licensed or qualified to do it, and we need to engage other parties. And so then the question mark comes about: well, if we're doing those other tasks, are we then doing them in our individual capacity, and then are we charging for them, right, or not charging for them? And if we're not charging for them, does that trigger non-arm's length expenditure? The short answer being yes. But if we are charging, is it because we satisfy the SIS requirements under 17B, which is certain things that we can be remunerated for? So we've got to try and balance this all out with regards to how we actually operate. And the key to 17B, for example, is that you are performing the duties or services other than in capacity as trustee, and you're appropriately qualified and hold all the necessary licenses to perform the duties or services, and you perform the duties or services in the ordinary course of business, carried on by yourself effectively, or performing similar duties or services to public, and you receive remuneration that is no more favourable to you than what is reasonable to expect if it was done on an arm's length basis. So again, I just jump back to my own example, right? I'm not qualified to be a fund administrator because there's no actual qualification that goes with it. Yes, there's qualifications from an accounting point of view, but to do fund admin, you don't have to be an accountant necessary to do it. I definitely don't provide those services to the public, and so therefore, under 17B, I would not be able to be remunerated. And even if I was an employee of an administrator, I wouldn't be able to be remunerated for that work, and that would be then potentially problematic. So we have to always balance this whole thing out with reference to where it sits with the work being performed, who technically can do that, and then who is doing it. And then the who is bit will then determine whether or not we're potentially going to have a non-arm's length issue. And so ultimately, what we're then going down through is this whole concept of working out whether or not we are doing something in our trustee capacity, or whether we're doing something outside our trustee capacity, regardless how insignificant it is, or how menial the task might be. Are we doing something outside the scope of being the trustee of the fund? Because if we do that, then we're creating a potential problem for the fund. And I highlight the key there on the right-hand side, where it talks about skills and experience. And so the tax office, again, I think in their interpretation, appreciating that the ATOs have got a role here to interpret the legislation, whether we feel that they took their interpretation too far. There's an argument, certainly from me in that regards in the early days, but they would say that they were just applying the laws that Treasury introduced. And if you go back through all of the papers, through all of the Treasury releases in the early days, the whole thing was about limited recourse borrowing rates and limited limited recourse borrowing arrangements and related party interest rates. That's how it all got triggered. And so how we landed in this end game really came about because of that, and has taken us to the next level. But in the ATO's defense, what they're saying is they appreciate or they accept that many people have the skills that allows you to perform the specific tasks, i.e. preparing your own investment strategy, because you can do those sorts of things. Again, I prepare my own investment strategy for my fund. I'm not a financial advisor, so I can't charge for it. I prepare my financial statements for my fund. I'm not a fund administrator. I don't charge for it. But after 20 plus years, I'm starting to reduce the size of the length of time I've been in the industry to a 20 plus, rather than putting a number on the end of it. I've got the skills and experience to be able to perform those tasks in my role as trustee. So it's still an area that we need to be mindful of. And again, ultimately what I provide there for you is a bit of an outline as to what the Commissioner has said in this space and areas that you need to think through. So let me have a look, let me run you through two private binding rulings that have issued in the last sort of 12 months, might be a little bit longer than that, but they deal directly with the NALI position around largely accounting services. And so in this first situation here, you've got the trustees provide accounting services at no cost to their fund. They're registered tax agents and they operate their own accounting business, but they've got no other employees. Trustee uses the firm's equipment, software and tax agent registration to lodge the SMSF return. The work is, however, performed outside the work hours at home. The trustees state it was always their intention to use their skills to perform duties in their trustee capacity and use the equipment and the tax agent registration, right, for cost and time efficiencies, right? So rather than having to go out and purchase other licenses or other software licenses and things like that, they said that's why they've done it through that process. And in this instance, in this PBR, the tax office came back and said that it does not result in non-arm's length dealings. So what that private binding ruling provides us, particularly from an accounting point of view, is that documentation is quite critical, because this fund had minuted all along that they were going to provide the services as trustee, they would perform it, and that they would utilize the business assets to do the work, but they showed what their intention was. Tax office said nothing to see here in that regard. Mirror that with this one, where again, accounting services provided at no cost, right? The individual provides services to family members and associated entities. So it was 18, this person was preparing 18 returns, including their own self-managed superannuation fund. Did all the work from home office, personally purchased equipment. So right now it's all sounding great, okay? The returns were lodged using an associated tax agent registration. Okay, so there might be some issues to consider there as far as using other people's registration details from a lodgement point of view. Prepares a self-managed super fund return for close family member. So this individual is not a member of the actual self-managed super fund. They are doing the preparation work for and on behalf of other family members. And in this instance, the parties were deemed to not be dealing at arm's length. And so back then, because this was before the legislation had been updated, that they were saying that there was a nexus to all the income of the fund, and so the entire income of the fund would be treated as NALI. Now that's a pretty significant outcome, but the key to this situation here was it was somebody else's self-managed superannuation fund. So if you see there up the top, it talks about doing 18 returns, including their own fund, right? So there was no NALI issue with them doing their own fund with their qualifications. It's because they were actually doing the work for another fund within the family unit, and that family couldn't rely on the idea that it was the trustee who was performing the task. It was rather that they'd engaged in an arrangement that provided a better outcome, a better financial outcome for the super fund, and so it was deemed to be NALI. So, you know, two similar in vein of the no cost associated with it, but quite different outcomes based on the nature of that arm's length relationship to be mindful of. Now, I had a question there. Hi, Tim. If an accounting firm doesn't charge accounting fees for a fund, not a related party, is this NALI? Well, David, I'm going to come back and answer that question, or try to answer that question in a moment, after I've gone through the example of the calculation, just because I think there's a little bit to that, and a little bit to that piece as to how you get to an answer of one way or another. So I want to be able to address that. So let's look at Melissa as a family member, not a member of self-managed super fund. So I've effectively taken the conditions of the failed PBR there and applied it to how NALI would actually be applied. So the SMSF uses Melissa's accounting services, which is deemed would usually cost $4,000. This here is the big problem for me. How do we know what an arm's length cost is, right? With 600,000 self-managed superannuation funds all paying different accounting fees. Yes, some pay the same fee to the same administrator. Whatever, there's so many different variables out there when it comes to fees that is this more of a scare tactic than an actual end game tax collection for the ATO? If it is, I think it's probably a valuable one in trying to get people thinking more along the lines of the nature of transactions than actually a tax collection mechanism there. But 4,000 would be a normal cost, but she charges the self-managed super fund $0, so it's a non-arm's length arrangement. So the income after the relative expenses, etc., is $200,000, which would normally be subject to our 15%. The income includes $82,500 of concessional contributions. So again, as I said, there is a link to taxable contributions within the calculation. It's not going to impact this fund here. Under the previous NALI rules, so under the pre-24 amendment, there would have been a nexus between the accounting services and all of the income of the fund. And so it would have resulted in a tax liability of $90,000, which is clearly, for a $4,000 fee, ridiculous. So it's totally off the scale. And thankfully, there was recognition provided with regards to that from a regulatory point of view. But under the new law, the income that is tainted is limited by the market value of the services for which no fee has been charged, and the amount of income is calculated by applying a 2 times factor on the difference between market value of the accounting service and the actual fee charge. Pretty easy when they charge nothing, right? Because in that instance, you go, right, well, what would you normally charge? This is what you have charged. The difference is going to be the amount. We're going to times that by 2. Pretty simple. If they have paid an amount and they've applied some form of discount, then it's only going to be NALI on that the difference between commercial or arm's length and discounted amount. So in this situation, the trustee would pay tax on 45% of $8,000 and then 15% tax on the remaining $192,000, resulting in $32,500 roughly in tax. However, if this was an arm's length arrangement, so the fund paid for the accounting services, then the taxable income is going to be $196,000 because we've got that deduction to offset it, and we're paying $29,500 in tax. So we can see that the NALI implications here. I mean, it's annoying. Obviously, it's annoying where we've got that additional $3,000 tax liability to pay. But if there's a 1-year slip up, that's recoverable, right? $90,000 tax is not recoverable. $3,000 tax is recoverable if we, take the steps to fix the situation. But let's now look at, again, going to David's question about an accounting fee not charging funds and it being NALI. And where we're at here is that the ATO have addressed discounts and pro bono. And as I said, I'll just sort of read this out, but we'll still be on arm's length terms where they're consistent with normal commercial practices, e.g. trustee being entitled to a discount under a discount policy, where they're provided to all employees, partners, shareholders, or office holders. Pro bono will still be on arm's length terms whether the trustee director is not, where the trustee is not able to influence the service provider's decision to supply the services on a pro bono basis. So therefore, David, what I would come back to and say is, okay, well, in the situation of an accounting firm not charging accounting fees to a fund, why, right? So, if they're not doing it because they're splitting the accounting fees over other entities or doing something like that, then I think that, and this is just my personal opinion because I don't think the tax office have given us enough clarity, but if we're saying, well, let's put the expense against other entities because they're paying a higher tax rate, to me, they need to look to split that back and pay it out of the the SMSF, even though it might be simpler. But if there is other sort of pro bono arrangements in place, right, and they're fixed and they apply it to multiple parties, then I would think that that it wouldn't be an issue. So I think really you need to look at the root cause of why they're not charging them, to determine exactly where they sit from a gnarly point of view. But for me, having spent as long as I have in the industry, I have a great appreciation that a lot of people don't charge the SMSF, because the self-managed super fund is the lowest form of tax, that is the lowest rate of tax, not form of tax, rate of tax of most entities that people are dealing with. And so they just invoice them for all of the work. And to me, that's what they're ultimately saying is, well, that's not how the law is intended. The fund, all entities should pay their reasonable amount, and effectively the balance is being dictated by the fact that the fund is not paying an expense. Now, the non-related part of the question, and this is a really, in simple terms, this is a one-line question, but this one-line question has so many different elements to it, right? Because we're talking about no payment being made, so we've got to look at why. Then we're looking at the fact that we're talking about an unrelated party. You can have non-arm's length arrangements with unrelated parties. It's generally rarer, right, to have that, but often you'll have it because of external positions or other relationships that exist in the sort of the ether of all of your entities. And so, if there is a whole, you might be dealing with a company, and there's other benefits that company being provided from a commerciality point of view, to say, right, well, we're not related, but if you provide us our business, then we're not going to charge you for that, and then you're going to cut costs in this area here. So, looking at those arrangements, once you move into that scope of there being the ability to influence the pricing, then there's going to be a problem. If, as a trustee, you've got no ability to influence the pricing, then that's when you're going to potentially have no gnarly considerations to think of. So look, that's the general expenditure piece, and having that understanding between individual capacity and trustee capacity, which is very grey in many instances. But when we start to speak about specific expenses, to me, this is actually the area that is of greater concern than the general expense piece, because not only does the specific asset gnarly concept impact the income, that income is going to incorporate the capital gain associated with the fund. And one thing that we know is that exempt current pension income does not override non-arm's length income, or as it used to be called, special income. So, if you do all the hard work in theory to plan out the fund through to retirement, you hold the assets through to beyond age 60 with the goal of selling down the assets in retirement and not paying any tax, the non-arm's length nature of certain transactions could just unwind all of that work from a pure taxation point of view, and you can lose all the benefits of the ECPI. Now, the key here, and I'll run through the main example that's utilised in the ruling itself, but the key here is that what we're looking at is not just transactions moving forward. We want to get clarity from the ATO that they won't take actions on anything that's been done historically. So that's obviously a key piece of all this, is that because these rules have applied from 2018 with specific fund expenses, that we're not looking at any renovations and other things that have been done and potentially not been done on commercial basis, and drawing a line in the sand like they did with the limited recourse borrowing arrangements in 2016 with the introduction of the PCG 2016-5 safe harbour rules. We're wanting to see that, one, we're not including gains before the legislation came in, right? Now, whether that might be a bit of a long way to get that from the ATO, but also having the ability to make good, right? So if a fund hasn't paid for something because it's dealing with related parties. So a related party builder is the classic example. Related party tradespeople are generally the classic examples of what we can contemplate here. Let's give us the opportunity to make good on that situation and rectify that rather than tarnish the gain in the future. So, okay, maybe the income that year is going to be hit with gnarly, but let's not push this all the way, kick the can down the road to CGT purposes and give us that opportunity. Now, I don't know what the status is of the ATO in regards to that. Let's hope. I'm not expecting it, but let's hope that to be in something in the final ruling. And if it is in the final ruling, then we can definitely give a bit of an update at a future session. But let's have a look at what we're talking about here, because this piece then links into the next part that I'm going to talk about, which is the TR 2010-1 contribution ruling. But in the example, and this example is example 9 in the draft and the original ruling, and that is Trang, who's trustee of her self-managed super fund, sole member, plumber by trade, runs her own business, sole trader, and employs other parties as well. So employs Nova. Has 2 investment properties in her self-managed super fund, which are leased for commercial rates of rent. So nothing untoward happening in this transaction. That's a stock standard SMSF with business real property and leased or residential property, as long as it's released to a non-related party. So as long as everything's commercial, nothing to see there. After finishing work for the day, Trang stops by one of the properties to connect a standalone water filter, which is going to be taken away at the end of the lease. So it's been provided by the tenant. She's just attaching it because she's got the skill. She uses her tools of trade to complete the installation. So Trang performs this activity as trustee of her self-managed fund and does not charge the super fund for the work. Trang uses the tools of her trade in respect of the property is minor. Her use of the tools is minor, infrequent, or irregular in nature and will not of itself indicate that she is undertaking these services in any other capacity other than as trustee of the self-managed super fund. So this won't be gnarly. Now, that satisfies effectively what we've always seen from the tax office, and the first example of that was SMSF ruling 2010-1, where they clarified the acquisition of an asset from a related party rule, and they said the provision of a service is not going to be considered an acquisition of an asset. And they talked about pretty much in that example plumbers replacing washers and doing things, and talked about the value being insignificant. So providing these menial sort of services at not much cost, no problems for the fund. But in respect of the second property, Trang undertakes a complete renovation of the bathroom and kitchen, schedules the time in her work calendar to undertake the work, uses the tools of her trade to undertake all plumbing work of the renovations, also engages Nova in all the work. Trang does not charge the super fund for the work undertaken in respect of the second SMSF rental property, and then in this instance, Trang uses the tools of her trade. It will not be considered minor, infrequent, or irregular in nature. Considering all her activities, she'll be considered to be undertaking these services in her individual capacity, that's fair, rather than as the trustee of the self-managed super fund. Because she hasn't charged, right, it will constitute a non-arm's length dealing between the super fund and Trang, which will result in the SMSF incurring expenditure in producing rental income that was less than otherwise would be expected if those parties were dealing with each other on arm's length terms. So there's a sufficient nexus between the non-arm's length expenditure and the rental income, and therefore that would be gnarly, but also it will result in the CGT being tarnished because it has an impact on effectively the cost base of the fund. Now, we can accept that outcome in this. When I say we can accept that outcome, we can accept the explanation is quite clear, right? So the position that the tax office have come up with there is understandable. However, if we go back to SMSF ruling 2010-1, the acquisition of an asset from a related party, if we go back to the TR 2010/1, the contribution ruling, the industry in my observation of it, the industry wasn't broken in this space. Now, the question always came about is if there is work being provided on the property that Trang was doing, the self-managed super fund, there's a contractual issue in regards to the fact that the SMSF cannot acquire the building materials from Train, right? Because that fails section 66, the prohibition on acquiring assets from a related party. But the rectification to that was you put in place effectively a contract, a purchase contract, to say that the self-managed super fund will purchase all of the necessary equipment, and then you're charging the labour for it. So that was one piece of it. The other piece of it was that the contribution ruling said, and still says even in draft format now, that if there are improvements made, right, then the value of that improvement, right, if you don't pay for it, then the value of that improvement is the contribution. And so whilst that still exists in TR 2010-1, the contribution ruling, you've got this situation where, is this example different if Train says up front that the value of the work that I'm going to be performed is going to be treated as a contribution? And you would have to argue yes, because that's what TR 2010-1 currently says. Even with all the other changes, it still says that. But there's a fear factor that because of the way that the ATO have worded these rulings, that they won't allow that. And so they won't allow you to provide those services, noting that the value is going to be a contribution. And of course, the key thing to that is, with the improvements in the value of a contribution, the way that the ATO previously defined it was the value of the contribution was the difference between the value of the asset before the improvement and the value of the asset after the improvement. And so that does create a bit of an anomaly here. And so, are we in a better position to say, well, what Train is contributing is the labour cost, right? And so should Train then be invoicing labour at commercial rates and then treating that as a contribution? As I say, I think that's going to be potentially a problem. But where's the ill intent behind that? Where is the mischief in that transaction if at the end of the day the fund value is enhanced from the performance? It's a sole purpose test element there. So are we just sort of digging for tax in these situations? So to me, it's still a bit of a problem, and that problem links into the acquisition of assets and the TR 2010 update, which really changes the narrative of that ruling to the point where it's basically saying that if assets aren't purchased at market value, then the difference, right, if they're counted as contributions to make up the market valuation within the financial accounts, if the original contract doesn't reflect the market value, then you're not allowed to use in-specie contributions to make up the difference, and it will be a non-arm's length acquisition, effectively, which will result in ongoing gnarly problems for the fund. Now, what's happened and what's occurred here is that we actually have seen the amendment to TR 2010-1, where they've inserted new paragraphs that are dealing with this whole concept of in-specie contributions. And so what they're really saying is, if you put a contract in place, and again, I just go off on a tangent a little bit here, but in dealing with self-managed super funds through the last 20 plus years, most people know what their intention is, whether it's been documented or not. So they might know, okay, we've got this amount of cash in the super fund, we're going to pay X amount of cash and then treat the balance as a contribution. What the ruling is saying and what the effective change of the legislation providing for is, that's okay, but now you've got to make sure that is explicitly stated in the contract up front. So we can't just treat the difference as a contribution, as we always previously did, and be okay. We have to stipulate how much the super fund is purchasing and how much the member is contributing, and ensuring that that contribution and the purchase, when combined, equals the market value of the actual investment at that point in time. And so to me, this is where we get scenarios where things like, I like to simplify and talk about things like off-market transfers and go, well, if you do an off-market transfer and you put the consideration at today's date, and then you don't actually sign the form for another few days and those shares go up, but you've actually listed a consideration for the 16th of September rather than the 20th September, then is the difference between the share price on the 20th and the 16th. Because if you're going to treat it as a non-concessional because there's actually been no money paid out, is that going to result in non-arm's length income? And to me, that's a place that we don't want to go down from an industry point of view. We want to have that flexibility. Go, okay, well, within a day or two, from a market valuation point of view, is it really that significant? Yes, if there is a long period between execution of the form and the consideration that has been listed on the form, if people try to manipulate and utilize concepts of 3 months rules, which don't exist, then potentially I think you do have a non-arm's length income issue. But for everyday activities, how close or how finicky are we getting with regards to our valuations and other considerations? So to me, it's a bit of a problem. And again, the examples that are used in the LCR and otherwise around in specie contributions, and they use examples which, to me, and what I wish from the ATO from a regulatory point of view is that they would actually have a greater appreciation for what occurs in the market, because very rarely are we going to see this situation of Russell purchasing listed shares for $500,000 when the market value is $900,000. If any of you online are dealing with Russell, you're going to say, hey, Russell, you can't do that, right? Russell, if these shares are worth $900,000, you've got to pay $900,000, right? And if you don't have $900,000, then you have to identify that if the fund's only got 500, then you're going to put in a $400,000 contribution. By the way, Russell, the contribution caps are, $360,000 if you've got your full bring forward available to you. Is there another member in your fund? Or are you using concessional contributions? Do you have carry forward? People are going through the entire strategy with Russell to get him into that position. So we don't have these sorts of transactions occurring. But if we did have this transaction occurring, that's going to be gnarly, and the income's going to be gnarly, or the dividend income's going to be gnarly, and all of the CGT on those shares at a later date is going to be gnarly. But what we know is that historically we would incorporate the market substitution rules, right? And so from a market substitution rule point of view, right, if we acquire the asset at less than its market value, then we need to modify that cost base. And if we modify that cost base, then that's what our CGT element is calculated on. I'm going to come back and talk about that in a moment. But when we look at it then from Russell's example, okay, so when the shares were acquired for 500,000, so Russell just got away with doing what he did and didn't get the right advice, sells those shares for $1 million 2 years later. For CGT purposes, the cost base is modified up to the $900,000, and then the capital gain is $100,000. Which is going to be taxed at gnarly. So, at least in that situation, if they're doing the wrong thing, you're not being taxed on the full difference between the gain from your totally inappropriate amount. It's only on the actual market substitution amount that we have to contemplate. Whereas if we look at Nadia's situation here, owns a commercial premises, leased to a third party, market value is $500,000, wants to transfer it but only has $400,000. She agrees to purchase 50% of the property under a contract for $250,000 and make a non-concessional contribution for the remaining $250,000. The acceptance of the contribution is recorded and reported in the fund's account, and she continues to lease the property on the same terms. There's no gnarly issue here, because Nadia has gone through the steps of documenting it up front. Now, one of the practical questions that is often difficult to answer here, because everyone's going to be a little bit different, is how do you represent that? Do you represent that in the contract, right? Or does the contract itself actually have in my sort of dealings, I would say the contract price should be the price that you're actually paying for it, so the arm's length cost amount there, and then the settlement statement should be, well, this is how the settlement is occurring, and the settlement is incorporating a contribution. There's going to be this amount contributed, and then there's going to be able to treat this amount as a contribution, and this is the actual capital outlay from the super fund point of view. So dealing with it there, but also preparing additional minutes to help guide through that process, to me, is appropriate. And so I won't go through James's example here, but this is a situation where the transfer is done, the price is agreed upon, but it's later determined that the market valuation was incorrect. In that situation, the amount, the difference is going to be treated as a non-concessional contribution to make that up. And again, what we're seeing from the ATO here, to me, doesn't necessarily reflect what we actually see in action within the industry itself. And so if we've got scenarios where in James's situation here, in Russell's situation, in Trang's situation, having the opportunity to make good where there was no sort of ill intent in the original decision makes common sense rather than tarnishing these assets forever. Now, TR 2010-1 had one other sort of area of concern, I think, for me with regards to its commentary. So assuming that we accept that the tax office have gone down a path of referencing in-specie contributions and asset purchases and having a link with NALI, that's fine, right? Like, they can take that position, and as an industry, we have to work around it. What is interesting is that in their contribution ruling, and this is a little bit off tangent because it's not really a gnarly thing, but is that they're referencing insurance proceeds as income, profit, or gain. But where it's objectively determined the purpose of the insurance payment is to be a benefit of a member, the payment may be treated as a contribution. So what they're also doing with this ruling is they're starting to make us question other elements, not just straight out purchases. And I just don't want to see us going down a path where we're second guessing every sort of transaction in regards to how we're dealing in a super fund space. So, not that there's really any link between NALI and insurance, but I just wanted to, whilst I was referencing the point about the contribution rules and in-specie contributions, say that ruling, when it's finalised, will be interesting for so many other elements for us to work out what the end ramifications are. So the final piece that I want to talk to you about today, and then if you've got any other questions, please put them in the Q&A box, is tax determination 24/5, which is to do with NALI and the CGT interaction. And this is an area, again, where it results in effectively a disproportionate amount of income potentially being taxed as non-arm's length income. And ultimately, all we can really say is this is how the tax law is written, because all the tax office have done in TD 24/5 is taken the CGT rules, right? Taken the NALI rules and applied them together. And this is the outcome that we get to. So it's not that the tax office have formed an opinion here, but it's a straight interpretation of the legislation. And so what the industry have tried to do, and I know the SMSF Association have spent a lot of time trying to argue the point with the ATO on this. However, the fact that it's at final release stage last year suggests that we haven't had the success. Again, is the outcome disproportionate, right? So what we've got a situation of is we know that that we've got to calculate our net capital gains, right? And when we calculate our net capital gains, we're doing that for statutory income to determine statutory income for NALI purposes and tax payable to the superannuation fund. What we also know is that NALI can't exceed the fund's net capital gains. So you can't have a NALI amount that exceeds the net capital gains of the funds. And so the NALI gain is subject to market substitution rules and is reduced by attributable deductions with the capital losses, including carry forward losses. And then we've got the tax payable method, which we use under 295(10). And so if we look at the example that is provided for in that in that tax determination, talks about Anya. She's the trustee of the Forger SMSF. Fund acquires an asset 2021 year for 100,000, market value of 800,000. Okay, so this is for the example's sake. Again, I'll get off the bandwagon of saying let's make sure we do the right thing here, but let's assume that an asset is tarnished with non-arm's length expenditure, right? So whether it's from an acquisition point of view or the asset is a property and it's been tarnished because of renovations or something else done. But we've got a market value of 800 here versus 100,000 under the scheme where the parties weren't dealing with each other at arm's length. The asset sold for $2.1 million to a third party in the 22-23 year, which results in a $2 million gain in accordance with that original $1 million, right? Sorry, with that original 100,000 acquisition. So in the taxpayer's eyes, there's a $2 million gain, right? If we apply the market substitution rules, what should have been reported was a $1.3 million gain, because we have a cost base of 800, and then we have a gain being the difference between 2.1 and 3. Now, there is a sufficient nexus between the expenditure and the gain, because our cost base was low to start with there. So we've got a gnarly situation. What we also need to know is the fund's got $500,000 worth of arm's length capital gains. And this is really the crux of the point of this calculation that I want to get to here. 500,000 arm's length capital gains, other assessable income of $883,000, and then a current year capital loss of 200,000 with no carried forward capital losses. So when we look at the calculations, right, if we go down the cost and what was reported by Anya in this situation, she would have the $2.5 million of total gains, which is the 2 million without the market substitution rules plus the 500, less the 200 capital losses, less the discount amount, gets a net capital gain of 1.5 million. Other assessable income 883, total assessable income of 2.4. In their calculation, no non-arm's length income, all low rate, tax payable of 362. That's why market substitution rules are important. If we focus on the gnarly bit, right, we've got a gain of $1.8 million. Okay, so that 1.8 is measured as the 1.3 million that's made by the super fund on the tainted asset plus $500,000. Right, so this is where my concern about this is. We plus the 500. We take off the 200. Right, we then subtract our discount, gives us a net capital gain of just over $1 million there. Other assessable income 883. Total assessable income 1.95. The non-arm's length component is that entire $1 million, right? So even though there was $500,000 worth of untarnished gains, they are incorporated into that net capital gain and become the non-arm's length component, right? We still have our low rate, the other income of 883, but we've now got a $480,000 non-arm's length tax liability on that CGT, plus then the 132 on the low rate component, totaling $612,000 tax. And so what that TD represents to us is a real problem for funds who ultimately have, let's say through some fault of their own, but that some fault being that they haven't paid for the costs associated with doing some renovations to the fund, and haven't had the opportunity to make good on it. If they then sell that asset in the same year that they sell a number of other assets that were subject to significant gains, well, they're going to tarnish those gains with that one gnarly transaction or that one gnarly event, versus doing this transaction independently. So doing a net CGT asset, or sorry, a net CGT calculation on non-arm's length component and a net CGT outcome on the $500,000, and then taxing them differently. Now, we've already got proportioning in the sense that we've got actuarial certificates. So the idea of separating income is not a bridge too far in the industry. It's not something that can't be done, but the ATO have said, rightly so in this instance, that this is how the law is written and always was written, and so this is how we have to apply it. And so it's a real sort of watch this area for your clients to say, if you've got clients in a situation where they've got something tarnished with non-arm's length income, all other transactions potentially can be impacted from a sales point of view. So to summarize today, the takeaways for me is that you understand what capacity people are undertaking the work in, right, to determine whether gnarly will provide. So it's going to come down to skill sets, what they're doing, but also whether the work being done requires some form of qualification, plumbing, electrical work. As I said before, I do my own admin. I also occasionally do my own plumbing. I do fix the washers, but I do it at that insufficient level. Of course, if I do it wrong, then it becomes that sufficient level, and I have to get somebody else in to pay for it. But it's understanding how much work we can do and are able to do in our capacity right? And identifying that as trustee capacity versus that individual piece, which then takes us down a path of 17B, takes us down a path of TR 2010-1 contributions, takes us down an SMSF ruling 2010-1 acquisition of assets from a related party, and inevitably takes us down a non-arm's length income piece as well. So we need to have all that clear. So we need to be benchmarking our services to be able to demonstrate that we're dealing on an arm's length basis. And if there are staff discount policies and pro bono arrangements in place, make sure that they apply across the board so that everybody is being entitled to them, to ensure that it's not a gnarly situation. And it doesn't need to, I don't think it needs to be said, but clearly the Commissioner thinks it needs to be said, dealing at less at market value will result not only in market substitution rules, but also at potential gnarly issues. And, the whole Section 66 makes it very clear requiring assets from a related party. It's got to be done at market value. So, anything outside of that, you've got to look at the scope of the transaction. So really, I guess the final point that I'll make is that we're really in a situation now because our PCG's disappeared and the legislation's in full force, even though it goes all the way back to 2018. We're really in that critical juncture where we've got to make sure that all our arrangements are done on arm's length terms. So look, thank you very much for attending today. I've got to sit down for the next few webinars for the year, and I'll put a topic together for each of them because as many of you know that I had planned on talking about Div 296. Well, at this point, my plan is not to do that so much.